If you're still trading Bitcoin like it's 2017, 2026 is going to hurt. You've probably seen the charts. Everyone's drawing the same lines, pointing to the Bitcoin halving and telling you it's a pre-programmed guarantee for explosive new all-time highs. It's a nice story, and it's one that has worked before. But what if I told you the most important driver for Bitcoin's next huge move has almost nothing to do with the halving? What if the real story, the one that will define Bitcoin in 2026, is happening right now? Bitcoin's next surge won't be written in code, it'll be written in policy. The 4-year cycle isn't what it used to be. And today, we are going to pull that curtain all the way back. For years, the Bitcoin market moved to the rhythm of a 4-year cycle, centered around the halving, the scheduled cut in new Bitcoin supply. The story was simple. After the halving, a supply shock kicks in and the price soars. And for a while, history seemed to prove it right. Early cycles delivered mind-bending, life-changing rallies after the halving. But a dangerous assumption is being made. Investors are looking at the past and expecting it to repeat perfectly. The data, however, suggests a different story, a story of diminishing returns. The rally after the first halving was astronomical, but the next was powerful, yet significantly less so. The one after that continued the trend. Some analysis of the cycle following the April 2024 halving shows this trend continuing, suggesting the market is maturing. Here's the uncomfortable truth. The halving matters less every cycle, and the market knows it. Because Bitcoin isn't owned by the same people anymore. Bitcoin's market cap has flirted with the trillions. The daily reduction in newly mined coins, while still a factor, is becoming less significant compared to the colossal flows of institutional capital and the sweeping tides of the global economy. In 2026, focusing only on the halving is like trying to navigate the ocean by looking at the moon while ignoring a hurricane gathering on the horizon. The game has changed. The players are bigger, the stakes are higher, and the rules are being rewritten. So if the halving isn't the main character anymore, what is? There are 3 forces driving Bitcoin toward 2026, and each one matters more than the last. These aren't just chart patterns or hopeful narratives. These are fundamental shifts in the global financial system. Force number 1, we'll dissect the new regulatory landscape, where the world's most powerful governments are no longer asking if they should deal with Bitcoin, but how. Force number 2, we'll follow the money and uncover Wall Street's role, how products like ETFs are creating a supply absorption effect so powerful it's changing the game. And force number 3, we'll zoom out to the most critical driver of all, the global economic climate, dictated by the Federal Reserve, which holds the key to unlocking the liquidity that could propel Bitcoin into the stratosphere. Stick with me, because understanding these 3 forces is the real key to figuring out where Bitcoin is headed next. For most of Bitcoin's life, the biggest threat has been the ghost of government intervention. The question was always simple: ban or allow? That fear created incredible volatility, but as we stand here in 2026, that conversation has fundamentally shifted in major financial markets. The debate is less about banning Bitcoin and more about integrating it. This is the single most misunderstood yet most bullish development. The move from existential risk to structured integration is the bedrock for institutional investment. This is why regulatory clarity doesn't cap Bitcoin. It unlocks buyers who were legally forbidden to touch it before. Why? Because the world's biggest pools of capital, pensions, insurance companies, corporate treasuries, don't run on memes. They run on legal clarity. For years, they couldn't touch Bitcoin. It was simply too risky from a compliance standpoint. That is changing. In the United States, there's a significant, though politically charged, effort to create a clear regulatory framework for digital assets. The passage of a clear market structure bill, which many analysts see as a major potential catalyst, would be a green light for a whole new class of conservative, deep-pocketed investors. It would define rules for custody, establish market guidelines, and provide the legal assurances fiduciaries need. This isn't about making it easier for you to buy Bitcoin. It's about making it possible for a multi-trillion-dollar pension fund to do so. Of course, this global shift isn't uniform. Some nations still pursue strict controls, and regulatory approaches differ. But the trend in major Western financial markets is toward integration. This process de-risks the asset in the eyes of the world's most significant investors. However, we have to be realistic. The small but real risk of a severe, coordinated crackdown by major economies still exists. Some bearish scenarios for Bitcoin are built on the foundation of an unexpected and harsh regulatory pivot. But the base case for many institutional forecasts in 2026 assumes this slow march towards clarity continues. It's the boring, structural work that could enable explosive price action later on. And here's the dangerous part. One of these three forces can stall Bitcoin completely, even if the other two go bullish. If you care more about why markets move than hype headlines, hit subscribe. This channel is about positioning before the crowd figures it out. Now let's get back to the money. If regulatory clarity is the key that unlocks the door, then spot Bitcoin ETFs are the armored trucks waiting to drive the money through. The launch of these products represents a fundamental rewiring of Bitcoin's market structure. Think about it. For years, buying Bitcoin was a complicated process for large institutions. ETFs changed everything. They put a Bitcoin allocation option on the desktop of every financial advisor in the country, right next to stocks and bonds. They made buying Bitcoin almost as easy as buying a share of Apple. But the real magic of the ETFs is their effect on supply. These funds act like giant vacuum cleaners, systematically absorbing Bitcoin from the open market and locking it away. Pause on that. Investors trade ETFs. The funds accumulate Bitcoin. And that's the part most people completely underestimate. By early January 2026, the value of Bitcoin held in US spot ETFs was estimated to be well over $100 billion, representing a significant percentage of the circulating supply. And this could be just the beginning, with some bullish analyst projections suggesting ETF assets could swell significantly by the end of 2026 if demand continues. This creates a powerful supply shock that adds a new dimension to the market, distinct from the halving. While the halving reduces the new flow of coins, ETFs are actively removing the existing tradable supply. This is happening as the amount of Bitcoin available on exchanges is already near multi-year lows. We have a situation where a new wave of institutional demand, funneled through these efficient ETF vehicles, is meeting a shrinking pool of available supply. We saw a preview of this dynamic in late 2025 and early 2026. After a market shakeout where ETF flows briefly turned negative, the tide turned. In early January, massive inflows surged back into the ETFs, with reports noting over $1 billion in just the first few trading days of the year. This signaled that institutional buyers weren't fleeing. They were using the dip as a strategic buying opportunity. This points to a critical shift. We're moving from the speculative, momentum-driven buying of past cycles to the strategic, value-driven allocation of professional asset managers. These investors aren't just chasing quick gains. They are positioning Bitcoin for the long term. This maturation is exactly what could attract the next, even larger wave of institutional capital. Wall Street isn't just participating in the market, it's reshaping it from the inside out. We've talked about regulation opening the door and ETFs providing the vehicle. But what's the fuel for this machine? The answer is liquidity. And in our financial system, the ultimate source of liquidity is the Federal Reserve. More than any other single factor, the Fed's monetary policy remains the biggest macro driver for Bitcoin's price. Bitcoin's most explosive rallies have all happened during periods of easier financial conditions, when the Fed is cutting interest rates and money is flowing. It makes sense. When government bonds are barely keeping up with inflation, an uncorrelated, digitally scarce asset becomes much more attractive. Conversely, when the Fed is tightening rates, it acts like a massive brake on risk assets, including Bitcoin. From here, Bitcoin has two futures, and the Fed decides. Scenario A is slow, controlled easing. As we move through 2025 and into 2026, many of the world's major central banks have been shifting their stance. After a period of aggressive tightening to fight inflation, many are now at or near the end of their hiking cycles, with some having already started cutting rates to support slowing growth. This shift toward a more accommodative monetary policy is the high-octane fuel Bitcoin may need for its next major leg up. Most institutional forecasts for 2026 are built on this scenario of modest, steady Fed easing as inflation cools. This would provide a supportive tailwind for Bitcoin. However, scenario B is forced, aggressive easing. Everything else you hear about Bitcoin in 2026 is downstream from this decision. The most aggressive bull cases, those calling for prices well above current levels, are often built on the assumption of this kind of easing. This could be triggered by a sharper than expected economic slowdown or a market event that forces the Fed to open the liquidity spigots with force. In that world, Bitcoin's scarcity could shine brightest. An event to watch is the end of Federal Reserve Chair Jerome Powell's term in May 2026, as a change in leadership could shift market expectations. Of course, the opposite is also true. The biggest risk to the bullish thesis is a surprise return of inflation. If inflation came roaring back and forced the Fed to start hiking rates again, it would be a major blow to risk assets. In that scenario, Bitcoin would likely feel the pain alongside the stock market. So when you're watching Bitcoin's price in 2026, you should be paying less attention to the block reward and more attention to the statements coming out of the Federal Reserve. So let's tie this all together. The old simple narrative of the 4-year halving cycle is breaking down. It's being replaced by a more complex and powerful set of drivers. The Bitcoin of 2026 is a macro asset, responding not just to its own internal clock, but to the seismic shifts in the global financial landscape. We have a regulatory environment that is slowly de-risking the asset. We have the powerful supply absorption mechanism of spot ETFs funneling a new class of investors into the market. And most importantly, we have a macroeconomic backdrop where major central banks are pivoting toward an easing cycle. When you combine these three forces, you start to understand the spectrum of possibilities for 2026. Think of 2026 in 3 zones. The green zone, this is the base case, a range between roughly $120,000 and $175,000, assuming steady regulatory progress, continued ETF inflows, and a moderate Fed easing cycle. A number of institutional forecasts cluster in this band. The blue sky zone. This is the aggressive bull case where Bitcoin could challenge $200,000 or even higher. These aren't promises. They depend on a trifecta of bullish catalysts, including aggressive Fed easing. The red zone. This is the bear scenario. A policy mistake, a new inflation shock, or a regulatory crackdown could halt the rally. In such a scenario, analysts have outlined potential corrections that could take Bitcoin back down into the $60,000 to $90,000 range, wiping out recent gains. The key takeaway is this: Bitcoin's price in 2026 won't be determined by one pre-programmed event. It will be the result of a dynamic dance between regulation, institutional adoption, and macroeconomic policy. We are at a pivotal moment. Bitcoin is graduating, evolving from a speculative phenomenon into a component of the global financial system. The training wheels of the 4-year cycle are coming off. Its future will be driven less by its own coded scarcity and more by the decisions made in the world's financial capitals. The secrets to the 2026 surge aren't hidden in complex on-chain metrics. They are out in the open for anyone willing to look beyond the halving narrative. You'll find them in the text of legislative bills, the daily flow reports of ETFs, and the policy statements of the world's most powerful central bankers. The halving didn't disappear, it just stopped being the star of the show. While the halving provides a steady tailwind, the true engine of the next surge will be the convergence of regulatory acceptance, institutional plumbing, and macroeconomic liquidity. If you want to keep getting ahead of the market with analysis that separates the signal from the noise, make sure you're subscribed with notifications on. Which matters more for Bitcoin now, code or policy? Let me know in the comments below. In 2026, Bitcoin won't be priced by believers. It'll be priced by policy.